The three pillars are technical analysis, ratios, and the bigger, longer term cycles. And if you can combine those three, it can give you an approach to the markets that you can repeatedly catch tops or bottoms. If you can buy a commodity below the break-even cost of your higher cost producers, that is the least risk area to purchase a commodity. There's a lot of opportunity here for investing in a cycle that hasn't really taken off much and people haven't noticed yet.
Today, we're going to try to find some value. I'm chatting with Andy from Finding Value Finance YouTube channel. Andy, thank you for joining me.
Yeah, thank you for having me on. I really appreciate it. So thank you.
Yeah, you talk about you have three pillars to your investing. Talk to us about that.
Yeah, so I started investing back in the mid 2000s. It was during the last commodity bull market. I kind of came fresh into it, right in the middle of it. And I was listening to a lot of people on YouTube, much like everyone's doing here and listening to us. And I wasn't very successful in investing trying to listen to experts through YouTube and through YouTube only. So just listening to their opinions and trying to make opinions based off their opinions. So at around, I'd say,
When you say listen to experts, what kind of experts do you mean? Like, you give me an idea.
yeah, so I would listen to people like Peter Schiff, Mike Maloney, those types, and I would listen to the information that they would um, give on YouTube, and then I would try to make investment decisions based off of, I'd say, their opinions. But I wasn't very successful as I went through the bull market from '05, '06, past 2011, 2012, 2013. Um, and since I wasn't that successful, basically riding through up and over and down, I wanted to figure out what was going on. How could I be better investor? So I started to develop my own approach, my own strategies. And three pillars is what I created, not from books, but just from my own experience in fundamental analysis and technical analysis. And I developed these three pillars, which I thought were the three most important things for investing when you look at any type of investment as an approach. The three pillars are technical analysis, ratios, and the bigger, longer term cycles. So market conditions or cycles. And if you can combine those three, it can give you a an approach to the markets that you can repeatedly catch tops or bottoms, not with precision, but get you in the general ballpark of where you need to be for the longer, bigger term cycles. So that's where that three pillars came from.
Okay. And now you like gold, silver, copper, platinum. Why?
Yeah, so there's a confluence of information, a merging of information coming together that we get a full alignment on those three pillars. So the technicals look fantastic. The cycles and market conditions are coming into favor for commodities and precious metals. And then the technicals on the charts look fantastic. The big driver in these cycles is interest rates. That's one of the big drivers. And we've had a 45-year decline in interest rates. The 10-year yield is what I look at. So we had a big decline from 1982. It bottomed in 2020, 2021. And now we're in an uptrend. We've broken that big downtrend. And interest rates are going higher. So that has big ramifications to money flows in the market. And those money flows can be seen from the technical analysis, the herd's psychology and the imprints that they're putting in the charts. You can see it. You can see it clear as day, and I can show examples if you guys want to see what those
Yeah,
look
go
like.
ahead. Please share the screen.
All right, I will share. We'll share silver and interest rates. So we're going to share it right here, and then it should be coming up. So this is kind of where I'll start. This is the US 10-year yields on the top. And then on the bottom here in the purplish color, burgundy color chart, that is silver. And the cycle, you can see the cycle downward in yields, upward in yields, downward in yields. And then recently, in 2021, we bottomed in 2020, 21, and we've broken through the downtrend upwards for the 10-year yield. As we move down in yields, we get these big consolidation or downtrends in the price of silver. The upward move and the upward move in silver, we've got a big cup and handle. A lot of people talk about this big 45-year consolidation cup and handle, which is a continuation pattern. Well, that cup and handle aligns very well with our decline in interest rates. So we've broken that, and I have every expectation that this cup and handle will break to the upside and that we will see a large, probably very prolonged period of silver outperformance against a lot of other assets. And the reason I'm using silver in this particular case is because we have the data and it was freely traded back here. Gold was not freely traded. So gold does follow this, but it wasn't freely traded back here. So I wanted to get something that shows everyone that it's freely traded and it moves with interest rates. So gold, silver, platinum, palladium, and all other commodities are going to do exceptionally well under these market conditions of an increasing interest rate environment. I'm going to show you another one here where I'll share the commodities to stock ratio. So as interest rates go down that we see in this portion here, money rotates from hard assets to financial assets. So what you're going to see in that environment is the bond market go up. You're going to see the S&P 500 go up under those scenarios. So if I were to just show you real quick an S&P 500 chart on a long-term basis, and this is kind of a busy chart here. Let me delete some of this out. These are your commodity bull markets, is when the S&P kind of runs sideways. And in between, so from 1982, if you guys remember that 10-year yield chart where we peaked on interest rates, that was basically right in this general area there. That's 1982. The big run up all the way up, that was a declining interest rate environment. So a lot of people, they speculated as interest rates go down, they take on more risk and they put money into the NASDAQ and the S&P 500. As interest rates bottom and shift and break out like we are, I have a feeling that we are going to see a rotation of assets away from financial assets back into commodities and hard assets and precious metals. So that's the bigger, longer term cycle. We can also see this cycle through another chart here, and I'll share it. Just have to yank it up. So it would be stop share, reshare this. That would be move the window. So that's this chart here. So if we look in history, this is commodities divided by the Dow Jones ratio. So commodities are overvalued when you're up high, and then when it's low, commodities are undervalued. If you look at history and you get these two asset classes to move against each other, you would want to invest in commodities down here in the mid to late 60s and then ride it all the way up till 1980, 82. That was the peak in interest rates. We've got a big consolidation coming all the way down, and right now we are basically at the cheapest time in history for commodities being undervalued to the Dow Jones in this case, or financial assets in general if you look at a bunch of different other information. So from a value perspective, historical value perspective of comparing an asset class to an asset class, commodities are drastically undervalued. And then if you take into account the yields that we were looking at, if you take into account when these assets do well and when they do poorly versus yields, we're right at kind of the inflection point of commodities breaking out and precious metals. So that's good. And another thing, I'll just bring this up as well for a charting perspective. And again, that was the ratio pillar. The conditions, the big market conditions pillars, the interest rates and the real estate cycle is another part of this. And then the technical analysis, when we look at the technicals here, this is just silver, looking at it priced in dollars. You can see that there's a repeated pattern in here. We call those fractals. Fractals are repeated patterns that occur throughout history. So I can grab a pattern and show you guys that it is repeating. So this here is the pattern that I just grabbed. You can see it's the same one there. What I'm going to do is I'm just going to line it up and kind of squeeze it up a little bit. And then you might see a pattern that is very similar. It won't be perfect, but it will be very similar. And what this is this is the human psychology. It's the herd psychology of humans trading together that creates these patterns over and over. What I'm describing is that the same pattern that was created back here is being created again. And the conditions, the market conditions that the humans are being subjected to, call it a high inflation, higher interest rate environment, humans behave differently. And that's the exact pattern that we are seeing being created as these conditions shift from a declining interest rate environment to an increasing interest rate environment. And the technicals agree with what I am saying. In fact, if I line this up kind of like I have it, it would suggest that silver could go to $225. The pattern would suggest maybe we get to somewhere around the low 300s. And if you do it on other scales like logarithmic and stuff, which I think I'm on, yeah, on logarithmic, it can go even higher than that. This is just price projections, not stating that it's 100% going to occur that perfectly. But it suggests much higher pricing. So that's kind of what I'm seeing in terms of market conditions, in terms of ratio analysis, and then also in terms of the technicals and what I'm seeing in some of these charts. And I'll just go through one real quick. Here's copper as well. This is just another commodity. It's I kind of consider this to be another way to ensure that you're kind of entering a bull market in commodities is you use copper. It's something that we use, Dr. Copper, for the economy and how things are doing out in the economy. So this is broken to the upside. We're sitting on top of a structure pattern. And whenever you're sitting on top of a structure, you get a big breakout. Basically, the resistance ceases to exist on it. And that's where you get these big breakouts. So this was another structure. So this is a structure that we broke back in 2001, and then we broke it in 2004. So we were breaking up and out. We hit the top of the structure, paused a little bit, and then broke out above it and ran again. We have a very similar structure. We broke out, hit and paused just underneath the top of it, and now we are breaking to the upside. So I think we're going to see a big move in copper and a whole bunch of other commodities as these are all interconnected through currencies as well, I'll say. So that's kind of the technical analysis. That's what I'm seeing in the markets. And that's where I basically gain my opinions, is adding up thousands of charts that I look at. That's kind of the data that I aggregate up into my opinions. It's all these different charts that I'm seeing.
Okay, and what are your thoughts on? There's a lot of talk about Donald Trump putting a lot of pressure on the Fed chairman to lower interest rates, and if he doesn't lower interest rates, his term ends next year in May. So do you see, you don't see interest rates coming down uh, when the Fed lowers interest rates, or the Fed chairman gets replaced by somebody else who will lower interest rates?
Yeah, it's a good question. Um, I'm not exactly sure what the long end of the curve, so that's the 10-year and 30-year yield. So what they control is the shorter end of the curve. They control kind of the Fed funds rate, and the 2-year yield kind of almost predicts what the Fed will do. I'm sure they're just a bunch of insiders trading off insider information, and then they just follow whatever the Fed will come out and do. But there's a possibility that they lower interest rates on the short end of the curve, and the on the long end of the curve goes up. There is a possibility that that occurs, and we'll see what happens there. If rates do go down, I would suspect that we are going to see more inflation, a weaker currency, DXY. So that's a relative strength indicator against other currencies. So I think the dollar will get weaker against other currencies if the rates go down. And if they do QE and try to do yield curve control through quantitative easing, that's when they print money and basically buy bonds and try to manipulate the curve. If they do that, they're going to send copper, silver, gold to the moon
Mm.
because they're basically sacrificing the dollar for lower yields, is what they're doing. And all of these commodities are priced in dollars. And your currency exchange rates will also be impacted as the dollar goes down. You'll most likely see strength in the Canadian dollar, the Australian dollar. And I can show you charts here real quick to verify my opinions as I look at all this and show that. So, real quick, if you guys want to see this, because I think it's highly important. So, this is the Canadian dollar versus the United States dollar. And when you look at these charts, you get these falling wedges. They generally fall in, I call it a three hump consolidation. It is the buyers and sellers starting to equal each other. So the chart compresses into a corner. Um, you've got lots of sellers up here, not many buyers. And then when you get to the bottom, they start to equal each other, and that's why it compresses into a corner like this. When it compresses into a corner, this is a big breakout where the buyers overwhelm the sellers. In this case, it's the Canadian dollar outperforming the United States dollar. And what we're seeing is we're seeing this compression. This was the last, this was a bear market in commodities. This is a bull market when it goes up right there. And then we are entering another bull market, in my opinion, as we can see the compression into the falling corner of that wedge. We've got the three hump consolidation. We've got this squeezing up right before a breakout. And currency exchange rates, emerging markets, and commodities they all kind of move together. But this is Canadian versus USD. This is Australian dollar versus USD. And again, you can see, maybe I took the stuff off. You can see the compression here in the Australian dollar versus the United States dollar, and you can also see the three hump consolidation into the corner. When this breaks up, it's going to unleash a gigantic commodity bull market. Um, and we're right at the beginning of this. There's a lot of opportunity here for investing in a cycle that hasn't really taken off much and people haven't noticed yet. It's a huge, huge opportunity. And this also occurs, I mean, it's in everything here. Um, this is the South African rand versus the dollar. It's trying to break out right now. And then the British pound already broke out. This was the last bull market of commodities, was that breakout there. So a lot of things are in alignment right now where I can't find things that don't align with my outlook or viewpoint in the markets that I'm looking around and searching for.
Okay, so if you have that view that commodities will break out, how do you make money from it? Do you just buy the commodities ETFs, or do you go into the mining stocks?
Yeah, so I think it's a good thing to do a combination of both. I like physical metals, silver, gold, and platinum. Platinum and silver are the two I like. It's based off of where it's positioned in relationship to their cost curves, at least when I was buying them. If you can buy a commodity below the break even cost of your higher cost producers, that is the least risk area to purchase a commodity. You can also look at the ratios like platinum to silver, platinum to gold, platinum to whatever. Platinum is the cheapest metal in the market in 2020 through 2024. And now it's just recently broken out to the upside. So, um, my metal that I like the most from a physical standpoint is both platinum and silver. So, physical metals, the actual like drop it on your foot stuff, is what I like, not an ETF. And then the equities, I think they're all very well positioned. They are very cheap in relationship to the physical metal too. So I think there's a lot of opportunities in gold and silver mining equities. You can buy ETFs. You can do individual companies. I think individual companies are worth buying. And then I also think a lot of commodity equities are also very good. I don't own physical oil or copper or anything like that, but I think that there's a ton of opportunity in certain areas in certain sectors to buy individual companies, and they will vastly outperform the ETFs. So if you get into a big bull market, just to give you an example, in commodities and why I'm so passionate about being invested in this space is that decades of returns can happen in years. You can see 20, 30, 40, 50, 60, 100 times your investment in returns in a 5 to 10 year period. But you have to hold the entire way. It's not easy. You'll have to endure 40, 50, 60% pullbacks along the way. It's not an easy ride. It's not easy. It's not for the faint of heart. It's not for those that don't want to put in any work. But the opportunities are here and the alignments are here from a valuation perspective, from the market conditions, and from a technical perspective.
Okay, fantastic. Do you have any final thoughts that you would like to leave my listeners with, and maybe how they could reach you or find you on social media if they want to learn more?
Yeah, so if you're interested in um, researching potential investment opportunities to take advantage of the setups that are here, I do have a website that you can sign up for, finding-value.com. You can use special as the coupon code on both the monthly and yearly memberships if you'd like to join. And I go through and find opportunities for everyone. I use technicals to get entry points and all that stuff for this coming bull market in commodities and precious metals. You can also follow me on YouTube. It's Finding Value Finance. And that's where I go. And I do daily updates. A lot of people want me to do daily updates, so I do that for everybody. Um, and then I also am on Twitter. It's finding_finance if you want to follow me there. So if you guys like investing and you want to learn, yeah, definitely sign up to the website.